Hi. So Minlu is off this week because he wanted me to teach you option trading. So this is a very basic introduction to options trading. There are a lot of concepts and technicalities that you would need to do your own research on, such as strangles, debit spread, credit spread, candlesticks, trend lines, volume. There's so many things, and I would recommend you to research it before you start. But with that said, this is an options trading course for noobs, explained by an intermediate noob for you basic noobs to understand. And hopefully I'll make it pretty simple that you guys can learn something today and make some money. So let's get started. So before you start trading stocks, there are some terminologies that you'll hear often. Obviously, there's like 100 different terminologies that you should know, but these are ones that I hear every day. And they're very basic terminologies that you should know, such as when someone is bearish or going short on a stock, that means they believe the market is going to go down. If someone is bullish and going long on a stock, that means they believe the market will go up. And one thing that I learned in the beginning and made a mistake of was the rule of buying the rumor and selling the news, which means you're buying the stock in anticipation of a future cash flow of a company. For example, when COVID-19 hit in March, there were a lot of pharmaceutical companies that tried to develop a vaccine for it. And one of that stock was Moderna. When experienced seasoned investor heard about the rumor, they bought up the stock and it hit an all-time high. Once the news came out and a lot of noob investor heard, then they sold the stock for a profit. So the noob investor came in, invested, the seasoned investor sold their stock, so the stock went down and the noob investor lost money because the price is already priced in. So with that, one of the most important difference between options and stock trading is that options expire. With stocks, you can hold onto a losing stock like the Moderna stock and wait until it goes back up for months or even years. However, with options, when the expiration date hits, you need to exercise or sell that option, or else you lose all your initial investment. The difference between stock trading and options trading is that stock trading requires a lot more initial capital, which gives you lower reward, but it's a lot lower risk and it's a much safer form of investment. With options trading, it requires lower capital, but it gives you a lot higher reward with that small capital, but it is a lot higher risk and a lot more volatile. So why do people trade options over stock? Well, for one, options can give you a higher return on profits in a very short amount of time. So for example, let's say the current price of Facebook is $165. In 60 days, Facebook goes up to $200, which means it went up $35. You bought 5 shares of it for $825. You sold it 60 days later for 35 times 5 shares is $1,000. So you made $175 profit, which is a 9% return. The same thing with options. If you buy $165 call is when you bet that a stock will go up, for $5 premium for $500, because remember you have to times it by 100, and you sell it 60 days later and the stock price went up $35 to $200, your premium would skyrocket because since the stock price went up, your contract went up and you're in the money. So you sell it for $15, which is $1,500. You made $1,000 profit or a 200% return. So there is a difference of 190% return if you trade a stock versus trading options. And that seems too good to be true, but that's just how options work. But remember, with options, it has an expiration date. If Facebook tanks like it did in March, you would have lost your initial investment if Facebook tanks instead of going up, since you bought a call and not a put. If you buy stocks and within 60 days, the stock hasn't moved, the stock trader would have no losses, while the option trader would lose the entire $500 investment. However, with options trading, you can also sell it for a smaller loss before the expiration date. You're still losing money if the stock goes down, but you lose less money. So there are two concepts that you should definitely know when you're trading options. and that is either buying a call or a put. A call option gives buyers the right to buy 100 shares of stock at the strike price. When you buy a call option, if the stock goes up, your premiums go up. Premium is the price of your contract that you bought, which I will explain in the next slide. The closer in the money, the higher the premium, but the bigger the profits. The further out of the money, the lower the premium, the lower the profits. However, this is what I learned from experience, and it doesn't work all the time. You have to look at the different premium price, but most of the time, this is true. Okay, like I said, the further out of the money, the lower the premium, the lower the profit. But since it's cheaper, you can buy more contracts, which means potentially you get a larger profit. For example, let's say you buy a $50 strike price, which is closer to the money, at $3, higher premium, and you sold it for $4 and you get a $100 profit. So you get a $100 profit for one contract. But let's say you buy further out of the money contract, a $60, and it's a cheaper premium, so you bought it for $1. Since it's only $1, you can get 3 contracts for $300. And when you sell it, you only make $50 profit per contract, so less than this one, 50% less. But since you have 3 contracts instead of 1 contract, you make $150 profit. So even though it's lower profit, you had more contracts, so you made $50 more than in the money contract. Basically, you make less money, but since it's cheaper, you buy more of it. So you make less money per contract, but you have more contracts, so it ends up being more. So the other one is a put option, which gives buyers the right to sell 100 shares of stock at the strike price. If a stock goes down, you make more money. So most people think that you can only make money if the market goes up, which is mostly true. But with options trading, you have the opportunity to make money if the market tanks. So this is how trading looks like on Robinhood. Obviously, when you're more advanced and you trade better, I would recommend using Thinkorswim, TD Ameritrade, because it gives you technical analysis and charts that you can look at to help you determine when to enter a trade and when to exit a trade. But that's more advanced. This is options trading for noobs, and I assume most noobs use Robinhood for trading. So I will show you how it looks like when you make a trade on Robinhood. When you want to make a trade, this is how it looks. And this is a screenshot I got from Google. So this is not the current price of Facebook, but let's make an example. So the current price of Facebook is right here, which is $164.64. This is the premium price that you want to pay for each contract. But the premium price, you have to times it by 100 by the marginal rate. So when it says $350, you're not paying $3.50 per contract. You're paying $350 per contract. Remember that. At first, I thought it was so cheap too. But then once I bought it, I was so confused. I was like, $350? I thought I only wanted to pay $350. But no, you have to times everything by a multiple of 100. Because it gives you the option to buy 100 shares of stocks when your contract exercises, which is confusing. So you don't need to know that. Just know that times 100 by each price that you see. So this is at the money contract, in the money contract, and out of the money contract, which is above your current price, and the in the money is below your current price. The strike price is what you believe the price of Facebook will be by this date. And the expiration date is how far away from the current date you want to buy the stock. Let's say the current price is $164.64, and you believe that Facebook will go up on March 23rd. So you buy a call at whichever price you want. The further out the strike price is, the cheaper it is because it's harder to reach. So you make a little less money, but it's cheaper to buy. And I will give examples later of how to do this. So here are some examples of live options trading. I'll show you on the screen right now. As you can see from my screenshot, that I do a lot of scalping. Scalping means that you get in and out of a stock quickly. I swing trade a couple of stocks, like I have a lot of Apple stocks that I'm swing trading. But yeah, I'm a scalper, so I scalp within minutes. So you see a lot of contracts that I do within the day. So the first example right here is CRNE. I scalped quickly 5 contracts for $460 at 10:02 a.m. And I sold it for $485 at 10:04 a.m. just for demonstration purposes. That means I made $25 in 2 minutes, which is not a lot. But if you think about it, a lot of people work an hour for only $15 an hour or even $8 an hour. So $25 in 2 minutes isn't too bad. But with the same thing, if you did stock trading, with that initial $460 investment, you would have only made $8.64 in 2 minutes. So the difference is 3 times more with options trading. This next one, I did a quick scalp on Plug. You know Plug has been going up, but it's been tanking the last 3 or 4 days due to market correction of all EV stocks. So I bought 24 contracts around 7:10 a.m. for $5,720. I sold it at 7:20 a.m. for $5,964, which is $244 in 10 minutes. And I was so mad at this because if I held on to it for another 10 minutes, it would have exploded to $1,200. Options contracts and prices, like I said, when the market tanks or when that stock tanks, the price and premium of the stock can exponentially increase. So if I held it on for 10 more minutes, this would have been $1,200 profit. But it's okay, profit is profit. The next one is Wayfair. I bought 2 contracts at $300 at 7:51 a.m. and I sold it for $355 at 7:55 a.m. So that's $55 in 4 minutes. And I also bought it at 7:15 for $300 and sold it at 7:26 for $530. With Wayfair, I was so mad also because Wayfair, for some reason, skyrocketed that day. And if I held these contracts, I would have made like $2,000 more if I held it for another hour or so. But you never know with it because it was so overpriced already. It literally tanked within like a minute of the highest of the day. So you never know. It was too risky and I didn't want to hold it. So that same day, like I said, stocks move fast, so it's not always profits. I lost $145 on the Bitcoin ETF Riot. I bought 5 contracts for $665 at 7:13 and I sold it at 7:21 for $520 for $145 loss. I didn't want to hold it any longer because I wasn't sure of the volatility of Bitcoin. Looking at my charts, there was no volume and my candlesticks was all red, so I just didn't want to hold it any longer. With these examples, you can see that options make a lot more money than stocks trading, but it's very volatile. It moves very quickly. You can make a lot within minutes, but you can lose a lot within minutes. You just have to learn the technical analysis, different candlesticks, different trends, and different types of trading before you get into it. Please do your research. I will put a bunch of YouTube links down below that I use to learn options trading, and hopefully it'll be helpful to you guys also. And before you options trade, I would recommend you paper trade. Thinkorswim is a good app to learn paper trading. Paper trading is basically you use fake money with live options that you can see how you would do in the real market, but using fake money. One thing about options trading is that in order to have unlimited trading, you need at least $25,000. If not, you will be marked as a pattern day trader if you execute 4 or more day trades within a week. So within a week, you can only do 3 day trades. Day trade means you buy and sell within the same day. If you buy a contract on the 13th and you sell on the 14th, that's fine. You can do that forever with less than $25,000. But if you buy a contract on the 13th and you sell it on the 13th, you're only allowed to do that 3 times a week, or else your account would be banned for 90 days. That's a little bit introduction to options trading. Hopefully you guys learn a little. To summarize, basically what you need to know about options trading is that if you believe a stock will go up, you buy a call. If you believe it'll go down, you buy a put. And the price of a contract you always times it by 100. So if the price says it's only 10 cents for a contract, which sounds very cheap, you have to pay $10 for the contract. And yeah, hope you guys like this video. It's my first video about myself. And sorry if it's a little confusing or amateur, but hopefully it's helpful. And you guys like the colors of my PowerPoint or whatever lecture thing. I made it all pink and blue and girly like how I am. So hope you guys enjoy the content, and if you like it, remember to smash the subscribe button. And oh yeah, remember to sign up below for 2 free stocks on Weibo. Maybe I should put my Weibo link instead of Min's Weibo link, because this is my video. We'll see. But yeah, click down below for 2 free stocks on Weibo to sign up. I think everyone should start stock trading, not necessarily option trading, because if you've never done it, stock is a lot safer. PSA, like a couple of years ago, I've always been afraid of stock market investing because you think that it's so scary and that you can lose all your money and stuff, but that's not true. Stocks eventually go up. And if with dollar cost averaging and all that stuff, then you can make a lot more money than just putting your bank in a savings account, which only gives you 0.01%. And I did that for so many years and I regret it, you know? So yeah, watch my husband's channel, learn how to invest, and hopefully we all retire within 10 years. Peace.